All right, let's get right into it. Today, we're going to talk about how to find those massive, trending days that every single trader is looking for. But here's the thing, the key isn't on your typical Forex chart. Nope, it's actually hidden in plain sight, right inside the bond market. Welcome to AI Explains ICT. In this video, we are breaking down the core content from month 10, episode 9. And trust me, this is a huge concept with a lot of moving parts, so I'd really suggest you grab a pen and paper. You're definitely going to want to take some notes. So here's our game plan. First, we'll talk about why we're always looking for those high volatility days. Then, I'll show you the real key to finding that volatility. We're going to break down a specific recipe for explosive moves, and then walk through a real-life case study to see it in action. After that, we'll get into the why behind it all, and wrap up with the big takeaway for your own trading. Let me ask you a question. Are you just sick and tired of getting stuck in that sideways, choppy price action? You know, the kind that just grinds your account down, only for you to then sit on the sidelines and watch the market take off on a massive one-sided move without you? Yeah, if that sounds familiar, you're in exactly the right place. Okay, so let's start with what we all want as traders, those high volatility trending days. These are the days where price has a clear direction, the moves are clean, and trading just feels, well, easier. And as ICT teaches us, these days don't just happen randomly. They have very, very specific telltale signs that come before them. The main idea here is super important. Markets breathe. They move from periods of low volatility to high volatility. Big, expansive trending days are almost always born from periods of contraction. You got to think of it like a spring being coiled tighter and tighter. After a few small, choppy, boring days, that energy has to be released, and usually it's released in a big way.
So if we know that big moves tend to follow small moves, the million-dollar question is, how do we know when that big move is actually coming? Well, the answer, the real key to unlocking it all, isn't on your Euro/USD chart. It's in the bond market. It's all about interest rates.
You know, ICT says it perfectly right here. Following the bond market is like having the key to a safe. The movements in interest rates are like the tumblers inside that lock. And when they all click into place, they unlock these huge energetic moves in other markets, like Forex. Seriously, if you're not watching the bond market, you're missing a massive piece of the puzzle. All right, this is where it gets really good and really practical. ICT gives us what he calls a common recipe for these big expansion days. This isn't just some abstract theory. This is a step-by-step framework with 4 specific ingredients you can look for to spot these setups before they happen. Let's break down the recipe. First up is the condition. You need to see that price contraction, a few small, boring daily candles in a row. Second, the context. Check your higher time frames. Has price reached a key premium or discount level? Third, you need a catalyst. Is there a high-impact U.S. news event on the calendar for 8:30 a.m. New York time? And finally, the fourth and most important ingredient, the confirmation. This is a specific divergence between different treasury bonds. That's the trigger. Now, theory is one thing, but let's see how this recipe played out in the real world. We're going to rewind the clock to June 14th, 2017, and watch exactly how these 4 ingredients came together to create an absolutely massive move. This is it. This is the confirmation. Look closely here. You can see that the 30-year Treasury bond made a new low, right? But at the same time, the 10-year T-note refused to go lower. It failed to confirm the new low. This disagreement, this bullish divergence is our trigger. This is a huge clue that smart money is stepping in and buying bonds aggressively, getting ready for a big move. And here's the payoff. On the left, you see the bond market taking off like a rocket right after that divergence. And on the right, look at what the Euro/US dollar did at the exact same time. It wasn't a little pop higher, it was an absolute explosion, a massive expansion day. The bond market literally unlocked the price and let it run. And just so you know, this wasn't some kind of a fluke. ICT points out several other examples. On June 2nd, you had a bond rally that led to rallies in the euro and the Aussie dollar. April 18th, same thing. Bonds rallied and the pound and euro took off. March 15th, it's the same story. This recipe shows up again and again. So we've seen what happens and how to spot it. But to really get this, you need to understand why it happens. Why in the world does a rally in bonds cause a rally in something like the euro? Well, it all boils down to the deep connection between bonds, interest rates, and the value of a currency. Think of it like a chain reaction. It all starts with the fact that bond prices and interest rates move in opposite directions. So, when bond prices rally when they go up, it forces interest rates to go down. When US interest rates go down, it makes holding US dollars less attractive for big investors. So, they sell dollars, which makes the US dollar weaken. And when the dollar weakens, what happens? Other currencies, like the euro, strengthen against it. It's a beautiful, logical domino effect. Okay, so let's put a bow on all of this. What's the big takeaway here? How do you actually take this information and integrate it into your own analysis starting tomorrow? Here's what you need to burn into your brain. First, those big trending days aren't random. They are often very predictable. Second, always remember that small ranges lead to big ranges. Contraction comes before expansion. Third, start looking at the bond market as your number one leading indicator for volatility. And fourth, use that four-part recipe. Look for the condition, the context, the catalyst, and that all-important confirmation. If you can master this, you'll have a massive edge. So I'll leave you with this one last question to think about. Now that you've seen just how powerful this connection is, how the bond market literally turns the key to unlock huge moves in Forex, can you afford to keep trading blind without it? Hey, if you got value out of this video, do me a favor and hit that like button, and make sure you subscribe to the channel so you don't miss the next one. If you have any questions at all, just drop them in the comments section below, and a real human will get back to you. Thanks so much for watching, and as always, safe trading.